Three forces are hitting Wall Street at the same time, and the combination is making investors nervous. Oil prices are climbing, Treasury yields are rising, and fresh tensions in the Middle East are adding a layer of risk that markets cannot easily price. Individually, each of those is manageable. Together, they put the recent stock market rally under real pressure. Start with oil. When crude prices rise sharply, the effect ripples quickly through the economy. Airlines pay more for fuel. Manufacturers see their input costs climb. Shipping companies face higher operating expenses. And consumers feel it at the pump, leaving less money for everything else. That squeeze on spending and profit margins can slow growth, and that is bad for stocks. But there is a second problem with rising oil prices. They push inflation higher. And that matters enormously right now, because the Federal Reserve is still deciding when to start cutting interest rates. Higher energy costs make that decision harder. If inflation stays sticky, the Fed has less room to ease, and markets have been counting on those cuts to sustain the rally. Now add rising bond yields. When the yield on the 10-year Treasury note moves higher, borrowing costs rise across the entire economy. Businesses pay more for loans. Home buyers face higher mortgage rates, and the federal government pays more to finance its debt. Higher yields also make bonds more competitive with stocks, meaning some investors shift money out of equities and into fixed income. That dynamic alone can push share prices lower. The Middle East is the third leg of this. The region sits at the center of global oil production and controls some of the most critical shipping lanes in the world. When geopolitical tensions flare there, markets tend to add what traders call a risk premium to oil prices, a buffer built in for the possibility of supply disruption. That premium can fade quickly if tensions cool, but if the situation escalates, it can grow and persist. The broader question for markets is whether the US economy is strong enough to absorb all three pressures at once. Heading into this stretch of uncertainty, stocks had solid support. Labor market data had been resilient. Hopes for Fed rate cuts were intact. That foundation is not gone, but it is being tested. Whether it holds will depend on two things: how the geopolitical situation unfolds, and whether the moves in oil and yields prove temporary or something more durable. Watch the 10-year Treasury yield and crude oil prices as your gauges. If both continue to rise, the pressure on equities will build. If either starts to ease, it could signal that the worst of this particular storm is passing. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.